Welcome to meeting number 43 of the House of Commons Standing Committee on Industry, Science and Technology. Today's meeting is taking place in a hybrid format pursuant to the House Order of January 25th, 2021. The proceedings will be made available via the House of Commons website. So you are aware the webcast will always show the person speaking rather than the entirety of the committee. The first hour today will be spent on C253, and then we will move in camera for the second hour to review a report. To ensure an orderly meeting, I'd like to outline a few rules to follow. Members and witnesses may speak in the official language of their choice. Interpretation services are available for this meeting. You have the choice at the bottom of your screen of either floor, English, or French. Please select your preference now. A reminder that all comments by members and witnesses should be addressed through the chair. Before speaking, please wait until I recognize you by name. And when you are not speaking, your microphone should be on mute. As is my normal practice, I will hold up a yellow card for when you have 30 seconds left in your intervention, and I will hold up the red card for when your time for questions has expired. Please keep your screen in gallery view so that you can see the cards when I hold them up. I don't want to cut anyone off, but we have a tight schedule today, so when you see the card, please take note. Pursuant to the order of reference of Wednesday, May 12th, the committee is meeting to continue its study of Bill C-253, an act to amend the Bankruptcy and Insolvency Act and the Companies Creditors Arrangement Act. I'd like to now welcome our witnesses. With us today, we have Mr. Mark Ziegler, barrister, solicitor, and partner at Koski Minsky. From the Canadian Bankers Association, we have Charles Docherty, Assistant General Counsel, and Bill Kennedy, Vice President, Special Loans, National Bank of Canada. From Chrysler Canada Retirees, Cody Cooper, President and Board Chair. Du Comité des retraités de Mine Wabush, Gordon Saint-Gilles, Président Sept-Îles.
Gordon Saint-Gilles from the Sept-Îles Wabush Mines.
Each witness will have up to 5 minutes to present, followed by rounds of questions. With that, we will start with Mr. Ziegler. You have the floor for 5 minutes.
Thank you very much, Madam Chair. It's good to be with you this morning. I've been involved in this area for 40 years as a practitioner with a firm that represents exclusively pensioners, retirees, workers in insolvencies, and of course other matters. And in that time, we've had some major cases and some major developments, but still we have a real problem with the protection of pensioners and disabled people, particularly in insolvencies. Most recently, I've worked on the Nortel case, on the Sears case at its beginnings with my partner, Andrew Hatney, who also worked for the Wabush employees, who I see are here. And we've been involved in many of these insolvencies. And regrettably, in 40 years of doing this, I've seen how hard pensioners get hit because these are unfunded future promises for their labor. Sometimes the corporations can fund them, sometimes they can't. 40 years ago, we talked about surpluses most of the time. Now we talk about huge deficits. Also a sign of the times in terms of lower interest rates, that creates big problems for pensions and pensioners. So when there's an insolvency, there is a big hit and we see pensions cut in half or even more. And without any protection to speak of under our legislation. I have to say that during those same 40 years, I and my colleagues have appeared before many committees of the Commons and the Senate, and there have been many studies. I remember the first time in the early 1980s appearing before Senator Molson's Senate Banking Committee when nothing much was being done. And now, at least in the 2000s and since 2005-06, we had the Wage Earner Protection Program in 2009. And there have been some enhancements since 2018, but this legislation has assisted mostly wage earners for lost wages, maybe some current pension contributions as opposed to the big special contributions that represent the deficits in pension plans. And it's helped active employees. It hasn't helped disabled employees who have unfunded disability programs, and it really hasn't helped pensioners in terms of special payments. But at least we made a dent in the early 2000s. But regrettably, Canada stands way behind other OECD countries in this area. Even the US, with its more laissez-faire philosophy, has a pension benefits guarantee fund. corporation that protects up to $60,000 US a year in pensions. The UK Pensions Protection Fund does even better. I think it's about £50,000. Here in Ontario, we have a small guarantee fund that protects all of $1,500 a month in pensions, and no other province has anything. The federal government has never acted. We created a wage earner protection fund for lost wages, but we haven't created a special fund for pensions. And so in this respect, we are way behind other OECD countries. Other countries besides the UK and the US don't have this issue as much for another reason. They have much better public pension plans available and social security programs than we do. Canada is really behind the times in this area, and it is sad and an embarrassment because it hurts pensioners. And having seen the devastation to people's pensions, and you'll hear more about it today, we have to do something about it. As an advocate, I recognize that insolvency is a zero-sum game, but the doomsday scenarios that are painted by those who say lending will dry up if you create a super priority haven't proven to be true. We have a wage earner protection fund. We have a small super priority for wages. Lending hasn't dried up. And in this respect, I want to quote some of the academic studies in this area, because there's one thing you can do here. I understand that a totally open-ended situation like C253, where there's a super priority for all pension special payments and disabled payments, can be problematic. But professors Janice Serra and Ron Davis of the UBC Faculty of Law have done several studies for the federal government. The most recent one, dated January 2019, there was a letter to the Innovation, Science and Economic Development Canada Director. And so this is not my idea, but I totally endorse it. You can create the super priority like C253 and put a cap on it. That means that you can say, and they recommend a $50,000 cap per individual pensioner's liability, and that will not dry up lending. It might increase some prices of lending, but we've seen lending hasn't dried up. The other thing to do is to create a federally sponsored guarantee fund. Well, the other thing I should note, you can create a cap and you can make them rank equally with secured creditors. With respect to a guarantee fund, I understand there are federal provincial issues, but you should create a study to have the provinces and the federal government work in this area. That is important. My time is up, so subject to any questions, that's all I have to say.
Thank you very much, Mr. Ziegler. We'll now go to the Canadian Bankers Association. You have the floor for 5 minutes.
Good morning. My name is Charles Docherty, and I am the Assistant General Counsel at the Canadian Bankers Association. With me today is Bill Kennedy, Vice President, Special Loans with National Bank of Canada. We appreciate having the opportunity to appear before this committee today, and the CBA has met with parliamentary committees in the past to discuss proposals similar to those contained in this bill. And we recognize that this is a complex and difficult issue. I would like to begin by briefly discussing the financial challenges presented by COVID-19. When the pandemic hit in 2020, Canada's banks worked in lockstep with the federal government, the Bank of Canada, and regulators to immediately implement a series of relief initiatives. And banks redeployed staff to create their own tailored support plans for individuals and small businesses to help them manage financial uncertainty and blunt the economic impact of COVID-19. Canada's banks have helped close to 800,000 homeowners with mortgage flexibility and provided more than 482,000 individuals with credit card payment deferrals. Banks worked with the Government of Canada to efficiently and securely deliver Canada Emergency Response Benefit to more than 3.4 million Canadians and facilitated interest-free loans to more than 869,000 small businesses through the Canada Emergency Business Account. Banks will continue to stand by their customers and bring tailored solutions to help foster a strong recovery. Part of a strong recovery, and a factor which is equally necessary to achieve economic growth in normal times, is access to affordable credit for businesses to allow them to invest and grow. It is the perspective of lenders to businesses of all sizes across the economy that we bring to the committee's deliberations today. A key part of banks' roles as lenders is to carefully manage risk, which includes being subject to a robust prudential regulatory regime. Canada's banks take very seriously their responsibility in this regard, making lending decisions based on a number of factors. The current legislative and regulatory framework is obviously an important factor in those decisions, and that includes the provisions set out in the Bankruptcy and Insolvency Act. A key objective of insolvency legislation is to provide certainty in the market to promote stability and growth. A very careful balance has been achieved over several decades in the order of priority in bankruptcy. When lenders decide to lend to a business, they have to account for the risk of the business not paying back their loan, and if the business goes bankrupt, how much can be recovered. The proposals contained in this bill would require banks and others who provide capital to businesses to factor in potential losses associated with unfunded pension obligations coming first in the event of bankruptcy when making lending decisions. This could mean less access to capital and higher borrowing costs. It is very difficult for a lender or other secured creditor to understand its exposure to a pension deficiency with a super priority, as it would depend on the availability of actuarial valuations, which are only prepared periodically. Actuarial valuations represent a snapshot in time, are based on actuarial assumptions which change based on economic conditions, and establish theoretical liabilities. This limits transparency and affects the ability for a lender or other secured creditor to assess its risk. Further, other unsecured creditors, such as suppliers, many of them small businesses, would also be faced with the reduced likelihood of recovering any amounts they are due, which may put pressure on their own finances. Ultimately, changes to the order of priority in bankruptcy threaten to seriously undermine the delicate balance with ripple effects across the economy, particularly when proposed changes are not undertaken within the context of a broader and more complete consideration of the entire insolvency legislative framework. We encourage the committee to examine other potential solutions, including the possibility of companies establishing solvency reserve accounts and pension guarantee funds, such as those established in the UK, the US, and right here in Ontario. Thank you once again for the opportunity to provide the perspective of Canada's banks as you consider the proposals in Bill C-253. We would be pleased to answer your questions.
Thank you very much. We'll now go to Mr. Cooper. You have the floor for 5 minutes. Mr. Cooper, you're still on mute.
How's that?
Perfect.
Thank you. I'm the president and chair of the CC Retirees Organizations for the non-represented salaried retirees of the former Chrysler Canada, as well as being the vice president of the Canadian Federation of Pensioners. The 23 member groups of the Canadian Federation of Pensioners total over 300,000 individuals, and our alliances with CARP, CanAge, and the National Federation of Pensioners, we represent the voice of millions of Canadian pensioners. The 2 decades of this century have been notable with the carnage inflicted on pensioners and the ongoing lack of meaningful measures taken to protect the income security of those who have retired with a defined benefit pension. In the press, these pensions are often referred to as guaranteed. That would be news to those from Nortel, Sears, and others who have seen their retirement security eroded as they were left unprotected because of the legislative scheme. Pensions are deferred wages, earned while working and payable upon retirement. The scope and the terms of the pensions are within the realm of the employer. No one forced the employer to make such arrangements. Pensioners deserve the pension promised by their employer. Unlike others involved in bankruptcy, pensioners' loss is forever, as opposed to a note or a supplier credit from a contractor or plumber. The responsibility to ensure pension protection falls upon government. Pensioners have no control, input, or approval over changes to their pension. Several countries do a better job of protecting pensioners than Canada. The United States, the United Kingdom, Germany come to mind. Somehow, their economic activity continues. There have been numerous consultations and submissions, including a request from the Canadian Federation of Pensioners to study the best solution to ensure full protection of pensioners in insolvency. To the best of my knowledge, there has been no response from government. The current government touts its whole of government approach, issued after the latest consultations. This is the equivalent of rearranging deck chairs on the Titanic. Bill C-253 represents the only credible solution on the table. This is a solution with zero cost to the taxpayer. There will be and always have been those who claim such measures would lead to more liquidations instead of restructuring. That intellects was the law of the land and the business world continued indicates this is just spin at best. Many of these opponents issued recent profit statements which belie the need to protect their interests at the expense of pensioners. Their assumption seems to imply management would not alter its behavior and treat seriously pension obligations and deficits. Corporations make decisions and act within the law. The law enacted by government has generated ongoing hardship on pensioners and their families. It's your role to address the problems which have arisen from your legislative scheme. Please, no more studies, consultations, or promises. A transition period is inevitable, but make sure it's not undue. This is Seniors Month. Do something real and do it now. Failure to act in a timely manner is the equivalent of senior financial abuse. Please support and enact Bill C-253. Thank you.
Thank you very much. Le prochain tour, c'est Monsieur Saint-Gillet. Vous avez la parole pour ça.
Mr. Saint-Gillet, 5 minutes. Oh, you're on mute. Hello, my name is Gordon Saint-Gillet, and I am part of the Wabash Mines Pensioners Committee. In 2015, Cliff put the Wabash Company in bankruptcy in the month of May. This meant that the retirees lost their benefits. And so I mean by that their drug insurance and so on. A lot of retirees, when they retire, they let go of the insurance because it would cost them more. So they maintain the company's insurance. In December of 2015, the actuary of the pension fund closed it because there was no more money coming into the fund. So the retirees, the unionized ones, lost 21% of their pension fund, and executive employees 25%. If you calculate that in general, retirees take out a part of their fund around the age of 60 years, they might have about 25 or 30 years of life ahead of them. That's a huge loss because there's no more salary increase. (21 or 25% of their income is chopped off right away. You also have the benefits. A person has to spend more to cover those that medication and a life insurance plan. If you pass away, well, there's your spouse, and this is a huge problem. In Sept-Îles, what we've done, since we are far, everybody thinks we're in the North Pole, we created a committee in 2015 in the month of May. And the idea was to represent ourselves. We have the support of the metalworkers. In October of 2017, in Ottawa, we went to Ottawa to support the former bill of our MP, Marilyn Gill. I hope that this time things will go further. It's very difficult for the pensioners to live with a small pension fund, and each time it's cut down and it's never increased. We went to Ottawa. We made a presentation. I'm sure a lot of MPs saw us at the time. It was beneficial for us because the Cliff Company saw us. We were on TV. We spoke up so that they would see us. Some people didn't believe that a group of pensioners would go, a group of people between 65 and 85 years of age, they didn't believe they'd get on a bus and go to Ottawa to make representations. And from then on, the company came to see us for some negotiating. And so that's beneficial for us because we managed to get back a portion of the benefits and a portion of our pension fund. We were at 21% for unionized employees, and it went to 7% of losses. So that might seem like a lot, but you do have to take into account the 30-year life expectancy. And so that pension fund is still static. And these are people who contributed to their pension fund. And this is a deferred salary, as was mentioned earlier. This is salary that people didn't get earlier. And usually when there's a negotiation, the company explains that it's a salary that belongs to you. But in truth, it's just money that they put aside. And they put it aside not because they have problems. These are rich companies. Cliff is not a poor company. So we always try to fight to get the maximum for our pensioners so they can live with dignity. And so that they can deal with their health problems and family problems. So I thank you very much for listening to me. Have a great day. Thank you very much, Mr. Saint-Gilles.
Thornton, you have the floor for 5 minutes.
Thank you, Madam Chair, and thank you for this opportunity to address the committee. I am the president of the Insolvency Institute of Canada, a nonprofit organization comprised of Canada's most experienced restructuring professionals in the legal, accounting, and financial fields. The mission of the IIC is to promote excellence and thought leadership in commercial insolvency policy and practice in Canada. Speaking personally, I've been a lawyer who has practiced exclusively in the restructuring arena for 37 years. During that time, I've been fortunate enough to have played leading roles in the restructuring of some of Canada's biggest employers, having defined benefit or DB pension plans, including Air Canada, Abitibi-Bowater, and Stelco, in the latter case twice. The views I'm presenting today are not just my own. They represent the unanimous view of the Policy Reform Committee of the IIC and have been endorsed by the board. The goal of the bill is well-intentioned, aiming as it does to protect vulnerable stakeholders such as pensioners from the consequences of insolvency. However, I regret to say that this particular legislative fix would have several material, adverse, unintended consequences, and they are: first, if enacted, this bill would cause a contraction of credit for non-investment grade companies and could trigger some insolvencies that would otherwise be unnecessary. Second, the bill would likely increase the cost of capital, making Canadian employers with DB plans less competitive. And third, This bill would make successful restructuring more difficult, with adverse consequences for employees, pensioners, and others. There are other and better alternatives to satisfy the bill's stated goals that I will address at the end if time allows. Turning first to the contraction of capital. Legislatively sticking pension deficits on top of the capital stack simply means that there's not as much value to go around to other creditors, including vulnerable unsecured trade creditors. If passed, lenders would find themselves in a situation where they cannot make real-time fact-based credit decisions because a solvency deficiency is not a fact. It's a forecast of what might happen over time in the future based on factors over which the lender has no control. Lenders may simply refuse to lend to non-investment grade companies with DB plans. Consider the position of an operating lender. If this bill is passed, the lender would have to ask what the deficit is today and consider what it might be over the entire life of the loan. In Air Canada's case, its pension deficit was over $1 billion when it filed. No operating lender who wants to get a first charge on liquid assets like accounts receivable is going to loan into a situation where they might be behind $1 billion priority charge. Secondly, the increase in uncertainty and risk faced by providers of capital will mean that the cost of capital will increase, making large Canadian companies with DB plans less competitive than their non-Canadian counterparts. Canada is already a high labor cost jurisdiction relative to the US and certainly Mexico. Thirdly, restructuring large employers with DB plans is already challenging. If this bill is passed, it will be even more difficult because it will hamper the availability of critical interim financing for distressed debtors. Such emergency financing, often called debtor in possession or DIP financing, is the lifeblood of restructuring. It allows going concern value to be maintained, and it avoids the dire consequences of liquidation. DIP financiers will not lend without a guarantee that their new money is in first place. There is before the Supreme Court right now in the Canada North case a challenge that statutory charges cannot be primed or overridden by a court order. If that decision goes against the lender and if this bill is passed, that will signal a significant challenge to any emergency financing of distressed employers with DB plans. The best solution for employees and pensioners of a distressed company is for that company to be restructured and returned to financial health such that it continues to pay wages and continues to make contributions to the pension plan. This bill, if passed, would lead in the opposite direction. There are, however, alternatives. One is to try to fix the problem at the front end, not the back. To limit or even eliminate shortfalls, you should, one, require calculations of pensions funded status quarterly instead of annually or more. Two, require more transparency in reporting to stakeholder groups, including regulators, unions, and pension groups. And three, require tighter timelines to achieve full funding. Catch the problem early and fix it while it is manageable. I see that my time is running out, but thank you for this opportunity, and I'd be happy to answer any questions.
Thank you very much. With that, we will now start our round of questions. Our first 6-minute round, we will start with MP Poilievre, but before I turn the floor to him, I'd be remiss not to wish him happy birthday. Mr. Poilievre, you have the floor.
Thank you very much, Madam Chair. Although there is a new study out from Harvard showing that too many birthdays is the leading cause of death. So I know you don't wish that upon me. Mr. Thornton, you gave a fantastic presentation, very well reasoned. I am going to challenge you on it though, because I think we get to better answers when we have a good debate. Your first point was that if we prioritize pensions over other liabilities, distressed companies could be forced more quickly into a bankruptcy. Can that not be solved by simply having a transition period for the coming into force of this bill, during which time companies with that are sub AAA that are have defined benefits could prepare themselves and repair their balance sheets in order to avoid that problem?
At the end of the day, it's a question of fairness. This bill does nothing to create value. So when you put somebody artificially on top of the capital stack, it means that there is somebody who's a loser. This is not a balanced bill. It's not a give and take situation. It's a take situation. So imagine, if you will, a stack of bricks in a tub of water. If you take one of the wet bricks out from the bottom and put it on the top, it doesn't mean that you suddenly have less wet bricks. It just means that someone else's brick has gone down into the underwater. What's happening here is that this bill will crush recoveries for unsecured trade creditors.
Right,
and they're the real vulnerable ones.
If I could, though, for those kinds of companies that are in a vulnerable position, can they not just we not have a transition period during which time they could get their balance sheet, including their pension viability, in order to comply with the bill and avoid bankruptcy?
Everybody tries to create value. Not every company is successful at it. Okay. So a period of time, while it might be beneficial, really does nothing to alter the fundamental mechanics of this bill.
Second, you said that the cost of capital will go up for companies that have defined benefit plans.
Yes.
This is actually, to me, a virtue of the bill. And let me tell you why. I'm worried about the fact that CEOs have underfunded their pensions for a long time and said, that problem is for the next CEO or another CEO down the line. And then when the pension problem emerges, the CEO who caused it in the first place is long retired and on his yacht in the Caribbean, while the workers are left holding the bag. Doesn't this bill bring the real cost of underfunding a pension into the present by making it more expensive for companies that don't properly fund pensions to raise money?
At the end of the day, greater cost of capital simply means the company is going to be less competitive in a competitive world. So
right, but Mr. Thornton, shouldn't that be the case? Like, if I have a company and I'm not funding my pension plan and I'm leaving possible problems for a future management to solve, then shouldn't I take a whooping from the debt markets? Shouldn't they say to me in the present, Mr. Polyev, you haven't funded your pension, so we're not lending you money? Wouldn't that create an incentive for me in the present to get my pension properly funded?
Possibly, but the solution that I have proposed would do that even more directly and wouldn't risk putting the company in an uncompetitive situation to do it. So you measure this, instead of right now, the deficits are measured annually, or sometimes only over 3 years, and then you're given 5 years to fund it. If you measure that quarterly, as you can now, and you can identify the problem while it's small and not this ogre that comes along to crush pensioners at the end.
Thank you.
And when it's small, you also put in tight timelines to fix it. So you bring the whole solution into the present.
I'll have to take a look at your proposal.
Not an indirect
Sorry,
way.
I don't mean to interrupt you, we're very short on time. Ms. Romanauta, how much time do I have?
2 minutes.
Okay, I'd like to give that to Mr. Genereux.
Merci beaucoup, Monsieur Polyev. Monsieur
Thank you very much. Mr. Thornton, you're the proof that there are two sides to this, because from the beginning we've been hearing from witnesses on this, and I, in general, agree with them, but I'm a businessman and I have a small business of 25, 30 employees, but large businesses often end up with pension funds that are undervaluated. And what you said, and from what I've understood, when banks look at the financing of a business, whether it's for their daily activities or for their recovery in the future if they're not doing well, they will look at the facts. Whereas you said that pensions are an evaluation and there's a real difference between the two. What could be corrected in this bill, or what could be improved in this bill to make sure that the pension funds can be better funded?
So what I am proposing is that you do three things. Actually, there's a fourth as well that my friend from the Bankers Association mentioned. But the first thing, you measure, you put the measuring process into real time, as close to real time as you can. It takes weeks to do the actuarial assumptions to figure out whether your pension is in deficit or not. But you do that quarterly, not annually, and then you identify shortfalls and tell the affected stakeholders, the pensions and the unions groups, and the regulator, and then you make the company funded over a quicker period of time. They just build that right into your pension legislation and inspire the provinces to do the same. I know in Ontario, FISRA is already looking at this kind of solution, and it's a good fix to the problem without affecting priorities.
Monsieur Ziegler, vous avez dit...
Mr. Ziegler earlier. Mr. Genereux? Apologies, but your time is up. Mr. Poilievre took a little more time because it's his birthday.
Sassy, you have the floor for 6 minutes.
Thank you, Madam Chair, and thank you to each of the witnesses. I found your testimonies to be very helpful. Now, if I could start off with Mr. Ziegler. Mr. Ziegler, you did say that Bill C-253 can be problematic. However, you did offer some solutions. We have heard that should Bill C-253 be adopted, what it will effectively do is discourage companies from having defined benefit plans going forward. What would you say to that?
I would say that horse left the barn 3 decades ago. Pensioners, most new pension plans are defined contribution arrangements or group RSP. The problem is you have hundreds of thousands, if not 1 million people in private sector defined benefit plans in this country. And this is the regime that we have. I'm not worried about new plans. I'm worried about protecting the people in the current plans. And I'm worried about the fear mongering, frankly, that says all lending will dry up. Everything will dry up if you create some kind of priority. We've created a super priority for wages, a small one, 15 years ago. Guess what? They're still lending. Lenders know how to study actuarial reports. They know how to study all aspects of a business that are problematic and depend on future sales or future developments or future interest rates or future mortality, which is what pensions are about. They're sophisticated. They can protect themselves. Other suppliers can protect themselves because they can spread their losses. Even workers can protect themselves to a degree. They can get another job. Pensioners can't do anything. Their pensions get cut and there's finality. So you have to do something here. And if you at least put a cap on this priority and you really study the solution that even Mr. Doherty recommended, create a viable guarantee fund. That's how you protect pensioners. But to do nothing just because this bill says creates a super priority over everyone is to ignore the problem and to let down the pensioners of this country.
So, Mr. Ziegler, my question is, you said that the horse has left the barn, but is it not accurate to say that certain companies now have two-tiered systems where they have defined benefit plans for some employees, but they're now grandfathering those, and for new employees, they have undefined benefit plans?
Yes, that's true. Many have hybrid plans where they create defined contribution benefits going forward. In fact, that's what Nortel did during the last 7 or 8 years of its existence, but the vast majority of their liabilities were defined benefit ones.
And my next question, Mr. Ziegler, is we've heard from Mr. Thornton. He has put something on the table, if you will. What would your reaction be to the suggestions that Mr. Thornton presented today?
I believe that, frankly, they aren't. They are not cognizant of what we have in this country. Pension plans are already very strictly regulated. Valuations can be required more often than every 3 years if there are problems. We have pension regulators in this country and in all provinces that make sure that funding of pension plans occurs in a viable, or try to make sure that pension funds are properly funded. What Mr. Thornton suggests is already being done. The problem with insolvency is a tsunami hits. Interest rates go crazy. Companies go out of business because their sales drop and their workforces drop. People live longer than the actuaries predicted. You have a bankruptcy. There's no fixing this by looking in the rearview mirror. You have to deal with the problem when the bankruptcy occurs. Pension regulators already try to fix it. And the solution Mr. Thornton has given you is a non-solution. At least Mr. Doherty mentioned a guarantee fund. That is a solution, but not quarterly valuations make no sense. It costs a fortune to have an actuary value a pension plan. They get done annually in many pension plans because the regulators order that. That's their job. That's a provincial responsibility. That's not something for this committee to do. This committee has to protect people once the bankruptcy occurs.
Thank you for that. Now, Mr. Cooper, how would you react to the suggestion or the recommendation that Mr. Thornton made?
I would tend to agree with a lot of it, but I also share Mr. Ziegler's focus that this is why we're here, is what happens when the shit hits a fan, pardon me. At the same point, the three people in the middle of my screen are also not telling you that every province basically is heading towards an 85% solvency level, which means you're capped at 15% loss going in, and you're still covering all the laws. Ontario did not increase its $1,500 payment at all, even though it should be about almost $3,000 now given inflation from when it started. So all of this arguing about the solutions has been going on for decades, but no one has ever implemented them. And when they go to the other forum, they say instead of 100%, we should have 85%, which is now basically the norm. So I'm tired of hearing it from both sides of the mouth.
Understood, Mr. Cooper, but just so I have a better grasp of what you are suggesting, you said there were certain elements of Mr. Thornton's recommendation that you agreed with. What are those certain elements?
If you had a uniform across the province's establishment of the timeliness with respect to the evaluations, it would be appropriate. You could then judge things on a national basis somewhat, even though it's provincially legislated. The fact of having a plan 3 years out versus 1 year, you should get closer to one.
Thank you very much. Le prochain tour, c'est député de Lemire.
MP Lemire, you have 6 minutes. Thank you, Madam Chair. It's a pleasure for me to be here in person. I would like to ask my question of Mr. Saint-Gelais, President of the Wabush Mines Pensioners Committee. I would like to send you the best regards of my colleague, Marilyn, and congratulations for your commitment. This bill, which is an act to amend the Bankruptcy and Insolvency Act and the Companies Creditors Arrangement Act, pension plans and group insurance plans, could have also been called the Wabush Mines Act to highlight your contributions to this debate. I'd like to hear you speak about the impact on the pensioners, the fact that they don't have a clear-cut act. C-253 is going to cover a portion of Canadians. Now, there can be major impacts on workers and their pension funds. Can you tell us what the impacts were for employees and pensioners of Cliff and Wabush Mines? Well, we have to look at what happens with a pensioner. The person retires around 60, 65 years of age. The person retires with the idea that during 30 or 40 years, usually it's between 30 or 40 years in our case, the person worked their entire life and they've contributed to their pension fund and they paid off all their debts before retiring, and they made sure they would have a retiree salary until the end of his or her days, usually around the age of 82, 83, some younger, some older. The retiree, well, the company files for bankruptcy because they made mistakes. In our case, they bought Bloom, and that cost them very much. They paid $4 billion for one mine. And to deal with that, they filed bankruptcy for Bloom, and then they waited 3 months, and then they took Wabush, which was another mine. And in my case, I was with Wabush. This mine was started in 1916. It was still very productive, but they filed bankruptcy. So these pensioners ended up with a 21% loss. 21 to 25% loss for the rest of their days. Now, a retirement, what you receive is not a huge amount. It's not a gold mine. You have to understand that if the person retired, well, depending on the year they retired, the amount is not the same. There is a significant difference in the amount of money they'll receive. And if you lose 21% on top of it, well, you're going to end up with a very minimal amount. It's almost poverty. And if on top of that you take away their life insurance and drug plan, and if they pass away, well, in our case, we've got the provincial amount, which is $2,500. You have to take tax off of that. You get $1,800. And I'm in a northern region, and it's very expensive. So these are the problems we have. For us, we would need it to be fair for pension funds everywhere, meaning that with C253, well, it would really help so that it be consistent and so that we be guaranteed our pension fund. Thank you very much for your testimony. I would also like to there's Mr. Lemieux, who represents the metal workers. He came last week. Now, this bill, well, it does not put the banks after pensioners. So the banks remain in the hierarchy. They come before pensioners, but pensioners will be able to be before school commissions. And so it'll allow you to make up for shortfalls. Is that the case? Yes, that's the case. We had a settlement with Cliff and FT Consulting. We had $10 million in sum. When the city of Fermont realized that we had that settlement and the school board, well, they went to court to fight for their rights compared to the pensioners, because we fought for our rights. Thank you very much. I would ask you one last question. It's actually for Mr. Doherty. What do you think about what Mr. Saint-Gelais is saying? He's saying that it's urgent that action be taken. At the same time, the bank's priority is being preserved, but we're talking about the dignity of our most vulnerable pensioners, who are also your clients. What would you say to that?
Sympathetic for what they are going through and what they've described. And we're just here today to outline the negative consequences of this bill. And as a few of the other witnesses have testified to, there are other solutions available that would help to avoid the negative impacts of this bill for companies that are trying to raise credit, have access to credit, restructure, grow their operations, employ employees, expand, and all those great things that help generate a healthy economy.
Thank you very much. Our next round of questions goes to MP Duval. You have the floor for 6 minutes.
Thank you very much, Madam Chair, and I want to thank all our guests for coming here today on this important issue. My first question is to, I guess it'll be to Mr. Doherty. Lenders and investors knowingly put their money into a business at some calculated risk. They do so with the intention of turning a profit. I see the workers as this type of investor too. They invest their time and labor, and they do it in a return for a paycheck, and in the case of an employer-sponsored defined benefits plan, for a deferred wage. Do you agree that this bill, C253, would finally put a much-needed change to the standard and culture of how we look at pensions, so that workers' investment in a deferred wage comes before investors that do so at a risk for a chance to make a profit?
Thank you. I have heard that term used during the testimony of deferred wages. Personally, wages are something that's earned while you're working for a company, and you earn that. I think what we're here to talk about today is unfunded pension obligations. And why I'm here in particular is to speak to the broader economic impacts of this bill if were it to be adopted, and the need to carefully study this issue given the broader context and the potential negative implications on the broader economy.
Thank you. So, Mr. Thornton, We've had a witness at committee who spoke the matter of concerns around lending when it comes to the change of priority of claims during bankruptcy. In the case of Sun Index Finance versus United Steelworkers, the pension deficit was ruled to be a deemed trust by the Court of Appeal for Ontario. This ruling put pensioners higher than even what Bill C-253 is proposing, and this ruling stood for about 2 years. As far as we can see, the sky did not fall for borrowers, and the sky did not fall for the lenders. Can you share any past evidence of measures like those in Bill 253 that negatively affected investors? Would we not expect investors to be able to easily adapt to this change that would bring fairness to workers getting their deferred wage?
Lenders really are not the issue here, and they will find a way to adapt. They may charge more for the risk that they're taking and they can't calculate. But the real person we got to talk about here are the unsecured trade creditors. Now, a 79% recovery for a pensioner is a bad thing. They're expecting 100. But the trade creditors are going to get zeroed under this bill. They're the ones at the bottom of the stack. And you know, today there's often something there for them. There will be nothing if the pension deficit is large and it goes to the top of the stack. And it's the unsecured trade creditors represent the micro, small, and medium businesses in the country that the World Bank estimates account for 80% of economic activity. So they're the ones that are getting affected. And no, they're not going to be able to protect themselves. They're going to still try to, you know, sell their products and services on credit and take that risk. And some of their customers are going to go down. And unlike now, where they will get some recovery over time, usually they are going to get zeroed. And for that reason, we should find the other solutions to this problem. Yes, it is a problem. Yes, it needs to be fixed. Inverting the capital stack with the priorities as this bill purports to do is not the right way to do that, in my opinion.
Thank you. But the problem is I keep hearing about trade contractors and the creditors, and it all depends on what type of a contract they have with that company. My next question is to Mr. Cooper, and I want to thank him very much for his intervention. Mr. Cooper, do you believe that members that you represent go into these jobs and sign on to a pension plans knowing that they are going to get something for their years of service, that when they sign on, they're doing so at a risk?
I'm going to try and be brief here. When you sign on, probably you're in your your late teens, early 20s, and you're not even thinking about it. When you get to the point of you're contemplating a retirement, even if you're 10 or 15 years away from it, you are trapped because of the terms of the pension. It's probably based on your best 5 years, and you can't afford to go anywhere else. And you are what we call prisoners of pension. You have to stay there because it's too lucrative not to.
Thank you.
You're definitely staying with the idea that you're going to get what you were told.
I agree with you 100%. So, Mr. Ziegler, do you believe that it's imperative that we make sure this bill somehow has to be identified and work has to be done to make sure that we're protecting our pensioners right across Canada, and that even though over the years all this many committees have been formed, it's time now that we act to make sure that Canadian pensioners are protected.
I fully agree. After 40 years of trying, and we learned 50 years ago that you can create a small super priority for wages and create a wage earner protection plan. Why can't we do the same sort of thing for pensions as a start? The world didn't fall apart because we created a super priority for wages. Let's create one for pensions, and let's create a guarantee fund.
Sure.
Thank you very much. And that's our time for this study today. Before I go to MP Baldinelli, I'd like to thank our witnesses for being here with us today. Merci beaucoup pour votre témoignage. Ça va nous aider.
Thank you very much for your testimony, which will help us very much in studying C-253.
Our witnesses to leave, and then I will turn the floor over to MP Baldinelli.
Thank you.
Thank you, Madam Chair, and thank you to our witnesses for being with us today. My motion that I shared with committee members last meeting proposes our committee invite Monique Gomel to testify for no more than 1 hour as the newly appointed interim chairperson of the Canadian Tourism Commission, also known as Destination Canada. Last year, the committee had the opportunity to testify. I'll call forward to testify Marcia Walden, the newly appointed president and CEO. And given the importance of our tourism sector and the devastating impact COVID-19 has had on this vitally important sector to our economy, I thought it was crucially important that we also have an opportunity to speak with Ms. Gomel. As you know, Budget 2021 commits $100 million to Destination Canada for marketing funds. And I thought as we go forward towards a recovery, that it's crucially important to examine Destination Canada's role in the use of those funds and the assistance it can provide in the recovery that's critically needed for a sector that prior to COVID was $105 billion. We're looking at 1.8 million workers, 2% of Canada's GDP. My community alone, 40,000 workers, 16,000 hotel rooms. My community is the #1 leisure destination for tourism in all of Canada. And we're about $2.4 billion in receipts. So it's crucially important, I believe, that we have an opportunity to speak with Destination Canada, Ms. Gomel, in her new role. Look forward to meeting with her. And of course, I was as part of that we do this before June 23rd and the recess.
Thank you very much, MP Baldinelli. So you've all received the notice of motion, and so I open the floor to debate. I see MP Lemire, vous avez la parole.
Merci, Madame la Présidente.
Thank you, Madam Chair. Well, of course, I support this motion by my colleague, Mr. Baldinelli. Indeed, I think that tourism is a priority and it should be maintained. And of course, we could ask about the direction. We're entering the last phase of the pandemic. So as part of the economic recovery, I think we should have this opinion. Now, there is one bill that has just come to our attention. I know we had at least one day that was free in our preliminary calendar, but I think that we're going to have to get creative, Madam Chair. I'd like to see which kind of plan you're proposing. Are there any other
interventions? Any other debate on this motion? Okay. Seeing none. Do we need, sorry, I'm going to go to the clerk. Do we need a recorded division, or can we just go strictly with if we have approval, consent?
If there's consent, then we will not need to go to a recorded vote.
Okay, so do I have consent of the committee to adopt the motion? Can I get some people to put some hands up, please, so I can see you? I'm trying here. I'm trying, Tony. All right. It looks like we have consent. 1, 2, 3, for the motion, and therefore I call the motion carried. Perfect. Thank you.
Madam Chair.
So with that, what I'll do is I'll ask the MPs if they could kindly log off of this Zoom and then get on to the Zoom of the in-camera portion of the meeting so that we can discuss the report. So with that, I will see you shortly. Merci.
Thank you.
And I will suspend.
Thank you.